Hey everyone, and welcome to This Explainer. I'm your subject specialist, and today we're breaking down the absolute ultimate foundation of financial intelligence, the accounting equation and equity.
And I'm your senior examiner. I'm here to show you exactly where candidates tend to hemorrhage marks under pressure and how the marking schemes actually work under the new syllabus. If you want to understand not just how to magically balance the books, but the precise underlying logic behind them, you are in exactly the right place.
Okay, let's dive right in. Here is our exact roadmap for today. We're starting with the core equation architecture, moving straight into step-by-step technical execution. Then we level up to AO3 ratios and evaluation before grounding all that theory in a real-world fintech application. Finally, I'll hit you with some crucial examiner warnings and pitfalls, wrapping up with a high-stakes pause and think ACE challenge.
Specialist, Section 1, the core equation architecture. Foundation of Financial Intelligence. So look, this module isn't just some basic record-keeping exercise. It's literally the bridge between everyday data entry and actual high-level financial intelligence. Remember, every single transaction has a dual effect. It causes two ripples across the accounts to keep everything perfectly balanced.
Absolutely. And listen up, because for the 2028-2030 syllabus updates, Cambridge has fully transitioned to modern international terminology. You've got to strike the old term bad debts from your vocabulary right now. Exclusively use irrecoverable debts. And similarly, always use owner's equity. This is not just semantics, guys. Using outdated terms immediately signals to an examiner that you just aren't up to speed with modern financial reporting.
Now, we constantly see a major conceptual clash in Paper 2, the historical cost principle versus the prudence concept. Historical cost essentially dictates that we record assets at their original purchase price, but prudence demands we never, ever overstate profits or assets.
Right, it's the classic accountant's dilemma. We will literally lose sleep over a 1 cent imbalance, but we also absolutely panic about violating prudence. If your inventory loses its value, ignoring that potential loss just to make your business look better is a direct violation of the prudence principle. You need to confidently navigate this clash using specific, precise vocabulary like accrued, prepaid, and realization.
Moving on to Section 2, Step-by-Step Technical Execution, the Methodological Approach. Specialist, to really minimize your calculation errors under exam pressure, you need an advanced technical methodology. The procedural flow always begins with identifying the correct business document, like an invoice or a credit note. That source document feeds into the books of prime entry, then straight into your T-account structure, moving through the trial balance and finally culminating in the financial statements. And let's quickly talk about coursework and practical applications here. When you're compiling coursework, documenting this source evidence meticulously is exactly where you secure your AO3 investigative marks. You must logically show how the business document justifies the prime entry. A super crucial technical detail in your ledgers? Correctly distinguishing between balance brought down and balance carried down. Don't mix those up.
Okay, listen closely to this rule, because it's a lifesaver. Method marks are awarded even if the final balance is totally incorrect, provided the logical flow is visible to the examiner. So the absolute most crucial point here is this: show your workings, especially when you're dealing with complex multi-step adjustments for depreciation or error corrections.
Exactly. If you make a tiny arithmetic mistake on step 1, but you logically follow through all the remaining steps, that visible trail mathematically salvages your grade. Do not try to do the math entirely in your head. Prove your logic right there on the page.
Specialist, Section 3, AO3, Ratios and Evaluation, High-Level Analysis.
Let's run a really quick Socratic debate. Imagine a business's current ratio plummets from a super healthy 2.5 to 1, straight down to a risky 1.1 to 1.
Examiner, why?
See, as an A-star student, you can't just state the obvious and say liquidity worsened. You must analyze the cause and effect chains. Has inventory been massively overpurchased? Is it just sitting dead in a warehouse somewhere?
Right. Or are trade payables being settled way too slowly? Perhaps cash reserves have been entirely wiped out because of a massive capital expenditure?
You must use your analytical tools to answer these high-level why questions.
Think about how different accounting policies heavily impact inter-firm comparisons. If Firm A uses the straight-line depreciation method and Firm B uses reducing balance, their net profits, and therefore their return on capital employed, are going to look completely different, even if their actual day-to-day business performance is identical. This is a classic evaluation trap. You have to look way beyond the surface numbers and truly analyze the quality of the profit being reported before you make any comparative judgments.
Because remember, the numbers don't tell the whole story, do they? Vital elements like staff morale, physical location, and overall market reputation are not captured anywhere in the accounting records.
Yet, these non-financial factors are absolutely essential for analyzing a business's long-term sustainability and deciding how reliable its ROCE actually is. An A-star evaluation always acknowledges what the financial statements cannot show.
Specialist, Section 4, Real-World FinTech Application, Beyond the Classroom. Based on the current research directives, let's look at a modern industry application. In today's landscape, AI-driven accounting software, like Xero for example, handles the duality of transactions automatically. When a business owner scans a receipt, the AI instantly categorizes the expense and balances the accounting equation perfectly, with zero human data entry.
Examiner.
Which is amazing, but fun fact, early AI accounting tools used to misclassify random things like office snacks as capital expenditure, and that's exactly why you still need to know the underlying theory. Banks and tax authorities demand total transparency. An accountant must still audit the AI, correct those misclassifications, and ensure the principles of prudence and historical cost are legally met. The software does the heavy lifting, sure, but the human provides the actual intelligence.
Section 5. Examiner Warnings and Pitfalls, the Survival Guide.
Based on the upcoming 2028-2030 syllabus updates, here is exactly where students lose easy marks under exam pressure. First up, poor handwriting in ledger accounts. Honestly, if I cannot distinguish your 0 from an 8 or read your balance CD, you lose the mark. Period. Second, mixing up revenue and capital items. Confusing the purchase of a machine with the simple repair of a machine completely destroys your profit calculations. So true. And third are the mathematical pitfalls. You absolutely must master the difference between trade discount and cash discount percentages. Trade discount is deducted immediately. Cash discount is entirely conditional on prompt payment. Miscalculating these is such a classic, completely avoidable trap.
Specialist. To combat these pitfalls when those exam nerves inevitably hit, you need a memory hack. The mental anchor I always recommend is ALE. Assets equal liabilities plus equity. Examiner, exactly. In the heat of the exam, just write ALE right at the top of your rough paper. If you're struggling with a really complex adjustment, go back to it. Ask yourself, okay, if I increase this asset, how am I balancing it? Am I increasing a liability or am I impacting equity? Locking in this simple mental anchor ensures you maintain 100% accuracy even under intense time constraints.
Section 6. Pause and Think, A-Star Challenge.
Okay, you have the theory, the execution engine, and the survival guide. Now, here is your challenge. A business discovers that a batch of inventory, which historically cost $5,000, was damaged. It can now only be sold for $3,000, but wait, it requires $500 in repairs first. Using your knowledge of the prudence concept and the accounting equation, exactly how do you adjust the financial statements and what is the dual effect on equity and assets? I want you to pause this explainer right now, grab a pen, write out the T accounts, and show me your logical flow. Specialist mastering this exact type of multi-step, logic-driven adjustment is the ultimate A-star secret. Thank you so much for joining us for this deep dive. Focused learners, keep practicing those T accounts, trust the equation, and we will see you in the next explainer.